All right, welcome everybody. Thank you so much for joining us. My name is Josh Whalen. I'm an advisor here at Altera Advisors, joined here by Grant Monson, another advisor here on the team. Grant, how you doing?
I'm doing good today, Josh. I mean, any day is a great day to show a few of our clients and people how to save millions of dollars on estate taxes. So I'm excited for our topic today.
Just like when you were a kid, you thought any day I get to talk about taxes is a good day.
Exactly. Since age 5, I've had
Yes,
my heart set
exactly.
on this.
um, well, so we're going to spend a lot of time today talking about taxes, strategy. Is this a risk? If it is for you, how can you address it? But Grant, before we jump into that, why would we spend so much time on this? Why, from your perspective in conversations with clients, why is this a big deal?
That's a really good question. The simple answer is it comes up a lot. And I was thinking back to a client we worked with recently this year. They came to us. They recently sold a very profitable business that they'd worked on for years to turn around and make a success. They've also built up real estate across multiple states, and even across country borders. And most importantly for them is they have kids they love, grandkids they love, and they just didn't want to see everything they worked so hard to build. They didn't like the idea of losing potentially half of that to taxes. And even more importantly, underneath that, and what we commonly see as a big driver is they just didn't want to leave a mess for their kids and their family of confusion and complexity and tax bills that they have to deal with. And so they're kind of sitting there wondering if they're stuck and kind of confused with all the layers of tax laws and how to deal with the issue. So it's a really prominent issue that we come across a lot.
Yeah, I think that's right. It comes up a lot. It's very frustrating to people. They're wondering if they're stuck. So we thought we'd take some time and address it here. All right. So the first thing to consider here is that we're going to be talking about big picture concepts, projections, illustrations, things that you should use to get an idea of what we're talking about and potential ways that you could consider addressing it. You need a specific team, advisors, accountants, attorneys that can help know your situation and figure out which, if any, of these strategies apply to you. But our objective here is to cover things from a big picture to help you have a better understanding of how this works and a handful of ideas you could potentially use to start working on the problem here. So we've got three things we're going to go through today. We've got what is the estate tax and how does it work? How big is the problem? This is a question we often start with before focusing attention on trying to solve a problem. We want to figure out how big that problem is. And then what can you do about it? What strategies can you use, or are you actually just stuck? All right, so let's start with what the estate tax is and how it works. So the estate tax is essentially a tax on your wealth when you die. When you go to pass that wealth on to the next generation, you're potentially exposed to estate tax. You might lose a chunk of that to the government, whether it's the state government, like in Washington State here, we've got a tax, or the federal government. So breaking that down, the federal government tax is up to 40% above a certain threshold. But as you can see here, the first just over $12 million, and that's for each spouse. So if you're married, each of you gets a $12 million, what they call an exemption, the amount you can pass tax-free. But everything above that threshold, you're going to lose up to 40% of that to taxes. And then on top of that, a handful of states add their own estate tax to that number. And our home state here of Washington just so happens to be one of those, lucky us, where each of you can pass just about $2.2 million tax-free. And then the rest of whatever you pass on is taxed up to 20% when you go to pass that on to the next generation.
And so like a simple round numbers approach to look at this is, let's suppose we're working with a client that has an estate value of $100 million at their death. Nice round number of 100 million. If they're married, then they get 12 million roughly each. So 24 million at the federal level. So this affects every state in the union, wherever you live. 24 million would pass tax-free. So that means you take 100 minus 24, then you're left with $76 million of estate net worth. That is now subject to the taxation that Josh was describing that's going to be subject to 40% at the federal level. And then depending on which state you live in, you're going to add on state estate taxes at that time. So we can look at examples where we'll see up to 50% of a net worth be cut down to taxes.
Mm-hmm.
So let's walk through high level how wealth transfers through our estate tax system. I know it's a really exciting topic here, but we want to break this down and make it pretty simple. So we want to focus your eyes here to the in the estate. So at the top left there on the chart, you'll see in there, and you'll see the client. So that's you all here as our listeners. So if you think about everything you own is in your estate, it's in your net worth, your assets. Everything you own is in your estate. The estate taxes are due at the passing of the second death if you're married. So if you're an individual, it's when you pass. If you're married, it's when the last of you pass, or this we call it the second death. So at that time, that's when your estate is valued for the purposes of estate taxes. And so if you follow down there, you'll see your assets are first, they're going to be subject to any state estate taxes. If you live in Washington State or one of the other states that have an estate tax, then they're going to be assessed the federal estate tax. So that was up to 40% that we talked about a minute ago. And then any of the assets that you have that have deferred income taxation on them, that tax is also still due on those assets over various timelines. So think about your retirement accounts, IRAs, maybe annuities if you own things like that. And then after those 3 bites are taken out of your net worth pie, you'll see that the remaining assets then transfer down to your family. And that's how your estate is set up before you do any kind of planning at all.
And people will look at this and go, well, if that's how it works, then, if I haven't done any planning, then I guess this is what I'm subject to. The way that we like to think about it is everybody actually has a plan. It's just the default plan, or it's a designed plan. What Grant just described is the government's default plan for your assets. They've got this all worked out, how much tax you're going to pay, and then who gets what, unless you make different decisions. So a lot of times in our discussions, we think about this as planning by default or planning by design. So we've seen examples like, all right, you're going to leave 100% of your wealth behind. Your family is going to get about 60% of that, and then 40% is going to go to taxes. So $4 out of every 10 is going to go to the federal government, and 6 passes to the people that you care about, that you've worked hard to build this for. And we've seen, by designing a plan that fits you and your goals, we've seen impacts as much as shifting to 90% or more going to your family and 10% or less going to taxes. Of course, this is going to entirely depend on what strategies you choose, what your goals are, and so on. But this is essentially how the system works, what the default plan looks like, and then you can take that and design a plan differently. The other concept that we think about is there's really only 3 places where money can go after you're gone. It's the government via taxes, it's charities via charitable contributions, and then it's to your family. The government's got a plan for what taxes you're going to pay. By default, nothing goes to charity, so you would have to elect something like that, and then whatever remains goes to your family by default. So in our discussion today, we're going to focus in on strategies that are going to address taxes and pass more money to your family to accomplish the goals and things that are most important to you. But it is important to understand this planning by default versus planning by design.
So before we jump into chasing down an estate tax problem, I think it's important for everyone to take a step back. As Josh was just sharing, is what do you want? Like, what do you want to have happen, and work backwards from that to design the right plan. And then when we start focusing in where we have a tax issue, it's really important to figure out how big is the problem, and really, is it big enough to solve? Sometimes people will find that, like, I'm completely comfortable with that tax problem, and it's not important enough to solve. So before you get too concerned with the state taxes, it's important to find out what the problem looks like. And so, it brings to my mind a good example, and a family example that we have here that we want to walk through with the Miller family. And that's kind of where they were. They're trying to figure out how big is the problem, and based on our goals, what should we do to set up our plan by design? So Sandy and James were about age 60, and they owned a consulting group for a long period of time. And their estate net worth, was about $5 million. And through some of their reading, they realized that they're now kind of moving into a threshold where they would be facing Washington estate taxes. And they wanted to figure out how big was that problem, and is there something we should do about it? And really the key thing in their life, their retirement income is set up pretty well. They have a good plan for that. They want to design their legacy. And their big key with their legacy is, can we preserve as much of what we've worked so hard to build to set up some vehicle or provision to fund education for our kids and our grandkids, and kind of really use what we've worked hard to set up the next two generations for success in their life. And so that was really the big defining, plan by design goal that they had for their life.
And
so
I think that's an important goal or a point to pause on for just a moment. We talk about wealth as a tool to enjoy your life, provide for loved ones, make an impact on causes you care about. For most of the people that we work with, Grant, you can tell me if this is your experience too. I find that people are not just focused on making their pile of money bigger just to say they have a bigger pile of money. They have goals like this. I want to see future generations of my family have education taken care of, so it's not a burden on them the way that it was for me, for example, is something they might be saying. So there's a goal attached to it, an impact they want to make. It's not just trying to avoid taxes and make your wealth bigger for just the sake alone of doing that.
Yeah, that's absolutely true. That's absolutely true. One of the things we need to do as planners then is look at how big is the problem. Is, these two are very healthy at this point in time. They're not planning to have that second death event that I described earlier and to pay the taxes now. Based on what they're doing right now, what is this going to look like at more of their life expectancy? So we went ahead and projected out their financial plan to about age 90. And what we'll see is that a $5 million net worth in their situation grew to just over $21 million. So it can catch up with you pretty quick. And that was a kind of a big aha for them in seeing how fast this will compound, and the problem actually grows over time. So it's really important for us to keep in mind what that looks like. Now, when we kind of fast forward to how will this be calculated, let's take a look at how big this problem was and run this through an estate tax calculator. So you'll look on the left side, a brief overview of how an estate tax is calculated. And we actually have this calculator posted for you on our website at altairadvisors.com/resources. You can play with these figures and plug in and figure out how big your problem is. So something to check out on your own time. With the Millers, their estate tax exposure is about $6 million, or that represents 28% of their net worth is going to be lost to taxes. So when we kind of reflect back and showed this to them and looked at it through their lens, again, it wasn't an obsession with the tax bill being the big problem. It was the fact that they saw that if they lost $6 million of their hard-earned assets, how detrimental that would be to the impact they want to make on their kids and their grandkids' future educations. $6 million will buy you a lot of private and public school education. And so that was the big why for them as to why we need to address this and get our planning more into the plan by design that we want to see.
And so now that we've kind of seen this this process, we're going to look at this iterated through two more clients. Again, the process of going, what is the concern? How big is the estate likely to grow? And then how big is the tax problem? So let's take a look at the Smiths here. Jessica and Jason, they sold their construction company. They worked their tails off from the ground up. They'd seen this thing go from a startup in their garage and then doing jobs for different folks around the neighborhood up to building up to this successful company. They sold it. They've got about 10 million in total estate value today. So when you add up all of their assets, it's about $10 million today. They just learned about the federal estate tax. They said, I don't want to lose up to 40% or more of what I have to taxes. I want more of that to be able to go and help our kids and grandkids, future generations of our family, be able to start businesses the way that we did. And I don't want to see a bunch of the wealth that could go to that goal be lost to taxes when I could have done something about it. So similarly for them, running their financial plan, we can see that their $10 million estate today at age 60 is likely to grow to something like $43 million by the time they're 90. And going back through our calculator, which again is available at alteraadvisors.com/resources, we put their net worth in here. They're worth about $43 million by projection at age 90, but their bill was going to be over $17 million. Now, that's a pretty significant jump from what we saw with the last family. The big reason here is now they're above that threshold for starting to pay federal estate taxes, which are the higher percentage and the bigger bite, but doesn't start applying again, like we mentioned previously, until your family passes on more than about $24 million today. For them, that meant about 40% of their hard-earned wealth was going to be lost to taxes, and only about 60% was going to pass to their family. And again, for them, they're thinking, how many fewer businesses could our kids and grandkids and future generations of our family have been able to start just because of this big loss to taxes? So for them, that was their big why. We want to make sure that future generations have as much as they possibly can to get a leg up the way that we had when we started, and able to build this financial independence for themselves.
Yeah, and when we look at it, one further example, we can actually take a look at how this problem can compound over time as the size of people's net worth increases. So let's take a look at Sharon and Steve. So again, about age 60, and their story is they built their entire empire and wealth through commercial real estate. So a lot of various assets that have compounded in growth over time to roughly a $50 million estate. So they have a very good lifestyle. They have good income streams coming. Now they're looking at, wait a minute, what's going to be the estate tax bill on this when we pass this on? And furthermore, we own a lot of real estate. We don't have a lot of portfolios or cash or other things like that. How are our kids going to deal with this mess of complexity of properties, and then also with a large estate tax bill potentially? And so they're trying to figure out how will we even have them pay for it. And we're not comfortable with the idea of them having to fire sale one of our properties or several of them to pay this large estate tax bill. So they didn't want to leave their kids a mess, and they also didn't want to lose some of these assets at a fire sale that they've helped build up over all these years. And really what they wanted to have happen is to be able to pass on this real estate portfolio as a legacy for years to come to help support the future kids and grandkids and kind of carry that legacy forward. And so that was kind of a big concern for them. So when we look at how their estate grew over time, again, 50 million by age 90 is turning to 216 million. So we're getting to some pretty large numbers here, and you could probably do the math. It's probably going to start growing this estate tax bill quite a bit. Well, it does indeed. So when we look at this, the estate tax exposure for the Billings was around $107 million. So if you look over to the right side, look at how this pie has shifted through these three examples of these different cases we've just shown you. Now we're looking at a 50% tax bite. So what started with our $5 million net worth client had a 28% tax bite. We have now gone clear up to a 50% tax bite. So the government's basically saying $1 for you, $1 for you, and $1 for me. So this kind of left the Billings a little bit uncomfortable, as you could probably guess, is where are we going to get $107 million to pay taxes when all we own is hard assets like real estate? And we really don't want to see that happen based on the goals that we have going forward. So it's a pretty big problem for the Billings.
So these are a handful of different examples, situations that we've seen over the course of our work with clients, different goals, different size of problem, but still kind of facing the same thing. How can I reduce taxes and pass more to the people that I care about to accomplish these goals that are so important? So to illustrate the question, or start to discuss the question, what can you do about this? We've talked about how big the problem is. Let's shift to what you can do about it. Let's go back to talking about how wealth passes. So as Grant mentioned a while back, everything starts in your estate. Everything you own, you have full control over it. But that means you're also going to potentially be facing these big tax bills that that might be coming due to estate taxes, income taxes, federal taxes, state taxes, all these different layers. We know that the problem might be coming down the pike here. So let's talk about moving assets from inside your estate to moving them outside of your estate. The benefits of having things in your estate is you have full control over them. You've got access to them whenever you need. But as we've talked about, the downside is you could lose up to half of that to estate taxes when you go to transfer it. So what we want to start thinking about is ways to move the assets out of your estate. And there's a handful of ways to go about doing this. Now, first of all, like Grant mentioned, doing nothing is an option here. You do not have to move any assets out of your estate. If you look at those estate tax bills and you say, I'm comfortable cutting a check to the government or having part of my wealth transferred to them, and then whatever's left over transferred to my family, that's an option for you. But if you're not happy with that and you want to do something about it, moving assets out of your estate is usually the first consideration that we make. So let's talk about really those three places where money can go. It can go to the government through taxes, which we've just talked about. It can go to charity, which is described here on the top line, and it can go to your family, which is here on the bottom line. We're going to focus in on charity and impact ways to reduce taxes and pass more to charity in a future discussion. So for today, we're going to focus in on how to reduce taxes and pass more to your family. So really two things to think about. You can make gifts today, you can write checks, you can pass assets, you can do things like that today. Or you can move assets into a trust, essentially a legal entity that now will own that asset, which will move it outside your estate. It means those assets are no longer subject to future potential estate taxes. And then at your death, then they pass on to whoever the ultimate beneficiary is here. The challenge there can be, what if I need those assets? And so we'll talk about how to face some of those concerns along the way here. But again, keeping in mind that the big picture here is to explore different ways to take assets from inside your estate and move them outside your estate. So we're going to start by talking about ways to preserve your Washington state exemption, something we talked about just a while back. So Grant, why don't you walk us through how this concept works?
Well, yeah, and if I actually, reflect back to the case study that we were using above here with the Millers, that they had, roughly a $5 million estate, and they were concerned about Washington estate taxes. And that concern was valid because they were getting into the realm of where they are going to be paying that estate tax. So they want to know how to handle it. So they basically, as you look here on the top bullet, you get 2.193 free. So if you're a single person and you pass away and you're worth $2 million, you will pay no Washington estate tax. If you're worth $3 million, then you will pay some tax. So pretty simple if you're a single individual. If you're married, it gets a little bit more complex because what happens for a married couple is it's not portable. So you said on the top line, it's not that exempt, that freebie of, I'm going to call it 2.2 for easy talking. That 2.2 million is not portable. So if you're married, so let's take the Millers, for example. If they're married and they do no planning and they're worth 5 million and they pass away, if they did no planning, 2.2 of their exemption, they'd be able to use. So that would leave 3.8 million that'd be subject to tax, and the remaining spouse would completely lose that 2.2 exemption because they didn't do any planning. That's a pretty costly mistake when the taxes on that are between 10 and 20%. That's a big oops. There is something that's, and the good news is it's pretty simple, that folks can do that live in Washington state or a state that has estate taxation. They can use a credit shelter trust. So what this trust does is, back to the example of the Millers, is they have 5 million at the first death. 2.2 million, so the amount of the exemption of their assets would move inside of this trust. So back to what Josh was talking about on that previous screen, out of the estate, it'd basically be held off to the side in a trust. However, the remaining spouse would still have access to it for some income and things like that. So they don't totally lose it, which is great. Then when the second spouse dies, that's when the taxes are due. They would get to use their individual exemption. So another 2.2, and then whatever's remaining of that would then be taxed. So kind of to summarize this, 5 million minus the first exemption takes us to 2.2 million, takes us to 3.8 million. Then at the second death, that remaining spouse uses their exemption now, another 2.2 million. That leaves them with 1.6 million that is taxable today, instead of doing nothing, which would leave 3.8 million taxable, which is a pretty sizable sum of money at about a 20% tax rate. So a very key strategy to use. It's actually very simple to set up inside one's will. And we won't go into those details, but a big way to save a lot of taxes on Washington estate taxes.
Yep, good call. I want to. We're talking about big picture strategy, lots of complexity. For our numbers, if we do 5 million and each of us gets 2.2 million, so that's actually going to take us to what, 2.8 million, and then down to 600,000 that would be potentially taxable, down from a much higher number. So what we're preserving there is that extra 2.2 million. That's at 20%. That's over $400,000 of taxes that we didn't have to pay, that went towards loved ones, and again, for them being able to fund education for their family. And this is, as Grant said, a very, very simple thing to do. Your attorney can make sure this is in your will. Very little complexity added here. This is very low-hanging fruit. So moving to a next strategy, you've identified that you've got this estate tax challenge, your potential estate tax exposure when you pass away. What can you do about that? Well, another thing you can do is make sure you don't have any remaining wealth above that threshold when you die. You can give it away along the way. So going to the case study of the Smiths, for example, they've got $10 million. It's set to grow up to a little over $40 million. While they're alive, they can take up to their $12 million each that they get to pass tax-free. They could give that to their family directly today. In Washington state, there's no limit to how much you can give away to escape the taxes. So for a lot of folks, the simplest thing that they could do is just give all their wealth away. Well, the challenge there is, what if I actually need that, right? If I still have, for them, they had 30 or more years of their retirement to live. So they're feeling this tension of, well, if I gave everything away, there's a lot of likelihood that I'm turning around and just asking for some of that back, or I'm moving in with the kids, or whatever it is. I gave you all the money to avoid the tax, and now I'm back in the asset that I just gave you. So again, giving the funds away along the way can be a good way to reduce the estate tax exposure. What we find for most folks, though, is that it's not the be-all end-all solution, because you're still alive and you still need assets to spend to support your life. And again, we talk with our clients a lot about not letting the tax tail wag the planning dog. And what that means is, we don't want to just orient strategy around reducing taxes as much as possible at the expense of you enjoying your life. So we have to balance all these things together. So while giving assets away while you're alive can be a good way to reduce taxes, it's probably not the only thing to do, especially if you are looking at a federal estate tax bill.
So then you can also kind of flip this around to the other side is, okay, I don't want to reduce it down. What if we look at a strategy where we just provide funds to pay the taxes? So again, the wins here would be, we get to have access to all our money. We don't have to face the uncertainty of giving too much away too quick and being in a situation where we have to ask our kids for money. So we also can look at ways to just look at the problem and create wealth to pay the taxes. So let's take a look at that for a second. And I'm actually going to refer back to the Smith example in this where they were worth about $10 million, if you remember, and we're looking at figuring their tax bill. And we look here on the next screen, we can kind of see how this plays out. Just as a reminder, we looked at this before. They're looking at about a $17 million tax bill, or 40% of their net worth was going to be lost to taxes. So we looked at this, was like, well, we can move funds out of the estate, but then again, we don't have access to them. So like, why don't we figure out a way to pay this tax bill? So in this example, the way that a person could do this is they can move a small portion of their wealth out of their estate and designed inside of that trust, like we talked about, out of the estate, and design it in a way to and put enough out there to grow it outside the estate and target an amount available to pay the taxes. So it does some slight reduction of in the estate, but it doesn't drastically reduce it so that you're concerned about not having access to enough money. Just moves a little bit out of the estate over time and creates a bucket of money that will pass down estate tax free, and also pay the taxes. The downside of this is the assets inside that trust over there, as they grow, they're still taxed along the way. And you still need to invest it and create that wealth to pay those taxes. So we can actually expand on this strategy of creating enough money to pay the taxes and do it in a little bit more efficient version. So I want to show you kind of doing a layer over how that trust could be structured to pay the taxes. So a real common way that we'll see clients utilize this is using an irrevocable life insurance trust. It's a very common tool, and likely it's very common because it's really effective. But let's break this down for a second. What happens here? So if you look at you there in the top left as the client, you're going to make an annual gift to this trust, which is outside of your estate. So the amount of this gift will depend on how much you need to have out of the estate to pay the taxes. So that'd be calculated based on that. And you make a gift and it goes inside this trust. This trust then purchases a life insurance policy and it owns it. So again, it owns it. So it's out of the estate. So if there was a $5 million life insurance policy, none of that value is inside your estate. It's outside because we moved it outside the estate. And the reason that folks are using life insurance in this case is that the growth of that asset. So if you're putting in $50,000 a year and it's going to pay out $5 million, just to make up some numbers here, none of that is subject to taxation. So it can grow from age 60 to 90. Here in this case for the Millers, they can grow that, have that $5 million, no income taxation, no capital gains taxation, and no estate taxation. So back to that 40% tax bite, this asset in their estate has a 0 tax bite. They'll get 100% of that money will go to their heirs, which you'll see at time of death, it will pay out to the trust, and the trust beneficiaries are their 2 kids. And so those kids will receive all of that money tax-free, and then they have the appropriate amount of wealth in order to pay the estate taxes that were due on their estate. And then the remaining assets can be carried on in the family.
Yeah, and you just mentioned them escaping a bunch of different types of taxes. Yes. So let's break that down just one layer further. Why does the money pass estate tax-free? Well, it's because it's sitting inside this trust that's outside the estate. But then how are they avoiding income and capital gains tax? So Grant, you mentioned, well, they still got to do something with this money while it's in the trust. Mm-hmm. Usually while they invest it, it's going to grow and kick out capital gains and things that otherwise would be taxable. Why is this avoiding those other taxes in this strategy?
Yeah, I'm glad you brought that up, because any taxes due in that type of trust will go right back to you as the grantor of the trust, and you pay taxes on it. So that, as we all know, taxes on wealth over time takes a big chunk out of it. So there's a couple things going on here. The number one reason that when it's done this way is because it's a life insurance policy is used. So the estate taxation is escaped because it's outside of your estate in an entity that you don't directly own. But the income and capital gains that you're asking about, that's avoided because the tax laws attributed to life insurance is no taxation as long as a policy is in force. So once money is inside one of those policies, any growth in that inside the policy is not subject to capital gains or income tax. And then the death benefit at the eventual passing of the grantor or the insured person comes out 100% income tax free as well. So when you do this beautiful combo of using the tax provisions of life insurance combined and sheltered inside of a trust, you then get this amazing effect of avoiding capital gains, income tax, and estate taxes. And that's why this is probably one of the most common estate tax planning tools used out there.
Yeah, there's quite a few folks that we go through lots of very complex options and ways they can move lots of different things around. And they go, wouldn't it be simpler just to put some money in this trust, have it buy life insurance, and then that just pays the bill? And we go, that would be much simpler. And so for folks, especially if you prefer the idea of just streamline and simplicity, this may not knock the tax bill down as much as a different mix of strategies. But it is pretty simple. It will allow you to put a stream of income in rather than having to take, these folks having to take what, $17 million out of their net worth in investments or cash or whatever it is and stick it in this trust. That's a much bigger ask of them than to send a stream of income to buy $17 million of life insurance. So for those reasons, yeah, Grant, like you mentioned, this is a very common strategy to pay the estate tax bill. And so for somebody like the Smiths, where their estate was going to grow from 10 million to a little over 40 million, if they implemented this strategy that we're talking about, they would knock down their estate tax a bit from 17 down to about 12. And that's because as they move those stream of payments out of the estate and into that trust to buy the insurance, they are moving some money out of the estate. That's not the main goal here. The main goal is to have funds available to pay the taxes because they still wanted to keep access to as much of their money as possible. But any money you move out of the estate is going to reduce the potential estate tax bill. But if you look over on the right, they're projected to pass about $33 million to their family when before it was just under 26. So they picked up a nice additional contribution to their family to help them start those businesses like they were able to. So for some people, they may not be, we talked about you can just pay the tax bill, but they may not be, you might not be happy just paying the taxes. You might actually want to focus in on reducing the tax itself. So Grant, let's talk about a way to actually knock that tax bill down a bit.
Yeah, absolutely. And, reducing the tax bill is always a popular ask until people realize that, oh, but wait, I got to give up access to that. Now I'm concerned about my well-being. And so it's constantly this balancing act. So it takes a lot of good planning. But there are some very unique strategies that we can help structure to kind of get best of both worlds to align it with a person's certain goals. So this next strategy that we're going to look at is we're going to help move assets out of the estate, again, with the goal of reducing the size of the in estate column so that we knock down the tax bill significantly. But we're going to build in some provisions of strategies that a husband and a wife could have access to the funds still, so they don't have to face that idea of totally giving up all the access to that money, because that can be significant and that's a hard pill to swallow. So we're going to start on the top left here. So this is a spousal lifetime access trust. Before we jump into this is a very specific strategy and it is not meant for everyone. There are pros and cons when you start working with strategies like this that people need to understand thoroughly, more than we would go into in this talk today. And so this is only done and crafted inside careful planning and coordination with your advisors. So financial advisors and planners like us, in combination with attorneys and CPAs, to make sure that there is a proper fit and understanding of how it works inside your plan. But let's suppose it does. How does this work? So you as the grantor spouse, so this is where this works for a husband and wife duo. It does not work for a single person. They would gift money to this SLAT, so spousal lifetime access trust. So they're going to move property over there. Now, Josh was educating you earlier on utilizing this large exemption. Remember with the federal exemption, you can give away $12 million each. So that's actually scheduled to go down in 2025 significantly, potentially cut down to where it was before, which is about half. So this is a good strategy for people that are looking, that are dealing with this kind of issue, to consider before 2025 when this exemption gets reduced, because you can give up to 12 million now and not pay any gift tax on it. After 2025, that number is dropping down into the 6 million range, and so you'd lose your opportunity if you didn't do it here in the near future. So let's suppose this client moves over $12 million to this SLAT. Now it can grow inside this trust, just like the previous trust we were talking about. You can invest it, you can put in assets that grow over time. The grantor spouse does not have access to this trust, because remember, they had to give it away. It had to move out of their estate. However, we can make the person, the spouse, the other spouse remaining, they can have access to it. So you can build in provisions in this trust where they can pull out income from this trust, and if designed appropriately, they can pull out tax-free income from this trust if they need it. So a lot of cases we find it's kind of a backup asset that they'll use in case of emergency, break glass, and we'll pull out of this trust, but certainly be designed so people can use it. Depending on how this is structured, you can have assets grow inside this trust. They're going to grow estate tax-free because we moved it out of your estate, but we can also make sure it doesn't pay, it's not going to pay state estate tax in Washington either, because it's out of your estate. So the funds can grow in there for years, completely outside of estate tax reach. And depending on designs of some of the investments in there, you can even get some tax-free income nature just assigned to it as well. At the end of both you and your spouse's life, in this case, the beneficiaries will end up receiving the remaining assets in this trust free of any federal and Washington and or other state estate taxation. So pretty powerful tool when used right.
And with a long time horizon, this is something that we would potentially think about for someone like the Smith family or the Billings family, folks that are going to have a federally taxable estate. And the reason that's an important threshold is the big gain here is moving that exemption amount, in this case, $12 million. Number one, before it goes down, but number two, today, so that, this is somebody with 50 million in their estate today, but that was projected to grow up to 200 million by the time they were 90. If they take 12 million out today and put it outside their estate, that's 30 years of growth that also happens outside the estate. And again, like Grant mentioned, you're investing, you're still trying to grow the wealth. You're not trying to miss any opportunity there, but you are trying to grow it outside of your estate, being very sensitive to strategies that, again, doing this helps to resolve estate taxes, but you want to be really careful with income and other types of taxes you might be exposed to as well. So good for somebody who might be federally estate taxable and still has a decent time horizon to grow their wealth.
Absolutely.
One of the things that we'll also see is that folks can combine some of these strategies. So it's really common actually for us to see this type of a trust be designed to also do the last example we talked about, which was this trust can own a life insurance policy that's designed specifically to pay the projected estate tax with a portion of the funds, then have the rest of the funds be invested and trying to be tax sensitive, but still be available in case, Grant, like you mentioned, it's the in case of emergency, break glass. That's a great analogy to put onto this. In case things don't go to plan, you need more access to assets than you thought, and you need to take some of those assets that you have put outside the estate and use some of them. So again, definitely something that needs to be advised by your full team, your attorneys, your accountants, your financial advising team, but a strategy that can make sense for the right fit. So for the Billings family, we see a pretty significant impact. So Grant, you want to walk us through what we saw for them?
Yeah, absolutely. I mean, let's start on the left side. The estate tax cut in half 107 million, remember, was due on that $50 million estate. It got cut in half by deploying that strategy that we just described. So 53 million of tax is a lot, but it's a lot less than 107. And like Josh was just explaining, often you're going to have assets inside that trust, maybe part of the life insurance and things like, you have tools that are going to be there right at the right time, ready to pay that bill. That's part of the design. Wealth to the family, which was their big goal, is how do we keep this property in the family for future generations that we work so hard to build? After deploying a strategy like this, the wealth impact's huge. Moved from 108 that'd be left over to 163 million left over. So this is a huge increase in wealth, combined with the fact of with having liquid assets designed inside that slat. They had the money to pay the tax bill that was remaining. So the taxes didn't get eliminated completely, but they got cut in half, and there's money there to pay it. And so in this situation, all of the real estate can stay in the family and they can carry that legacy forward. And then the tax bill has been provided for and paid, and the money's there instantly when the tax bill is due. A very meaningful impact for the Billings family and their situation it's pretty big, as you can see on the screen here.
Yeah, so we've hit on a couple of ideas of ways to reduce taxes and pass more to the next generation, either paying the taxes to pass more or actually knocking the tax bill down. But what if you're thinking not just about the next generation, but 2, 5, 10 generations down the line? There are ways to make your trust last for many, many generations. And that's through something that you might hear called a dynasty trust. Really, all this is talking about is how long this trust that you're working to set up can last before everything is closed out and it's sent to the beneficiaries. These rules are governed on a state-by-state basis. So, for example, in our home state of Washington, a trust cannot last longer than 150 years before it's closed out, beneficiaries, and all the assets are distributed to the beneficiaries. It's not in our laws here in Washington don't allow for trust to last for hundreds of years. But contrast that with Alaska. If you set up a trust in Alaska, that could last for 1,000 years. So you're talking about many future generations of your family where not only have you moved assets out of your estate for the next generation, but you've potentially set up a legacy that could survive for hundreds of years, and be able to continue this legacy of impact on many future generations of your family. So we've talked about ways to reduce taxes, potentially keep some access to your money, pay those taxes, create flexibility for your family. But what about ways to make that impact on charity? What if you're focused on, I want to make sure we enjoy our life, want to make sure our family's comfortable, but our big picture goal here is to make an impact on causes that we care about. And we're going to address that in a next session. So be sure not to miss that.
Absolutely. So, when thinking about this, we've showed you a lot of different ways of doing this. And all of it really comes down to our encouragement for all is to pursue a plan by design. How do you want to set up your wealth to enjoy your life and support the family and or causes that you care about? That's planned by design. Everybody has different wishes and goals for how they want their wealth to be used and what they want to do with it. And that's really, really important. And so when it comes to thinking about, okay, I got this problem, I have this estate tax problem, what do I do? The first thing we want to think about is how much do you need to enjoy your life? So you need some good planning to make sure that under all circumstances, you're not worried where your next retirement paycheck is coming when you're 80 years old or 90 years old. So how much do you need to enjoy life, and make sure that's planned out really, really well. Then once you're taken care of, then you can think about, okay, now what do I want as my design? Who do I want to leave my assets to? What do I want for my family legacy? What do I want for charity? And within our families, what do I want for the family business too? That all goes into that bucket. Or what combination of both do we want? There's not any right answer. The right answer is what aligns your wealth with your values. And that's what this is all really about, is aligning those two. And then there's a couple things that we want to encourage you is don't wait, start now. And that seems like something you'd hear a lot. It's always good to do planning earlier than later. There's hardly a circumstance that isn't, but there are a couple key things that are really pushing in on these strategies right now. We are facing some potential tax reform, but we don't know what that will be. But more importantly, there is one that we do know is going to happen, is that federal estate tax exemption is going to cut in half by 2025. So that was baked into the tax reform of 2017. And by 2025, that sunsets, and it's going to reduce that federal estate tax exemption. So remember, that's free money free of taxation money that you can pass through your estate. That's going to get cut in half by 2025 per the current legislation. And that's a big missed opportunity for people that could be utilizing that. It is the highest that it has been in all of American history. So potentially hedging your bets to take advantage of this free tax savings could be a good part of your plan. And we encourage people to start building the plan out now and figuring these things out. You can adjust and measure over time. You can't wait for, well, what's going to happen with this legislation or this president or this next thing. It's important to have this plan in place and then adjust and measure with your advising team over time and adjust for changes in legislation as they come, because we're never going to be able to predict that all with a certainty as to what will happen in the future generations of tax legislation.
Well, great advice, Grant. Thank you for that. A couple of really good questions to ask yourself if you're trying to pick what strategies are right for you and develop your thinking around this. So with that, we're going to close out this session. Thank you all for joining us. For more resources like this, articles that we've written and other resources that we have, you can visit alteriaadvisors.com/insights. Make sure not to miss the next session where we're going to talk about ways to reduce taxes and pass more to charity. And with that, thanks again for joining us, and we'll see you next time.